Whether you're a saver or a borrower, the question many people are asking right now is when will interest rates start to come down? So in this video, we look at the near-term forecasts, both for the UK and for the US, to see where we might be headed over the next few years. And we also look at the longer-term drivers of interest rates to see where we're going to be headed over the longer term. This video is sponsored by Trading 212, a UK commission-free investment platform. So let's look at when interest rates will start to fall in a bit more detail. Let's begin with those forecasts. Here's the forecast from the Office for Budget Responsibility for the UK, and this is a forecast for the bank rate. This is the central bank policy rate. Now the blue line is the forecast from November, and the yellow line is the forecast from March of the same year, 2023. Now this is something we'll see in all of the forecasts, which is that it's going to take some time for rates to start to fall. Most of the quick wins will happen over the next couple of years, and currently we're roughly at the peak rate. So for bank rate, OBR is forecasting that it's going to fall to 4% at the end of 2028. But a large proportion of that fall is going to happen in the next couple of years. So that's by the end of 2026. If we look at the summary of economic projections, or the dot plot that the FOMC does, this is the rate setting committee in the United States. Now, as the Fed is always reiterating, this isn't strictly speaking a forecast, but it is what members of the policy rate setting committee think, so it's pretty important. And each of these black dots is what one of those committee members thinks is going to happen to their policy rate for each of the years ahead. So by the end of 2024, the median expectation is a rate of 4.6, falling to 3.6 in 2025 and 2.9% in 2026. And by that point, it'll be very close to the long run average, which is 2.5%. So again, a lot of that fall is going to happen over the next 2 years. And of course, the US is further ahead than the UK, and their rate will be lower by the end of this period, by 2026, than the UK, by over a percentage point. Now, as the Fed always says, this is data dependent. If we get another surge in inflation, then everything will change. This is just conditioned on their expectations for what's going to happen to inflation, but also to unemployment. And here's the expectation from the Bank of England for the UK. You can see it's pretty similar to the OBR forecast. So even by the end of 2026, they're expecting that the policy rate, bank rate, is going to be at 4.2%. So nothing like we saw pre-pandemic. The era of free money is over, and it's going to take longer than markets think at the moment. Now that policy rate is very much driving the short end of borrowing, so borrowing over very short periods of time. If we look further out for longer periods of borrowing, and here of course I'm thinking about mortgages, but also if you buy long-term gilts, this would apply to you, then looking back at yields since 2010, you can see we're pretty much back to normal, assuming that was normal. What is unusual at the moment is the short end of the curve. Usually that's lower than it is now. The long end is roughly where it was about 15 years ago. The reason why the short-term interest rate is elevated at the moment is because the yield curve is kind of flat and high. And that's because of the central bank policy trying to fight inflation. So what we would expect is that as inflation comes under control, the short end will move down, the long end will probably remain pretty close to where it is now, and the yield curve will get steeper. So if you're going to be fixing your mortgage for, say, a 5-year period, or maybe even a 10-year period, or in the US, a 30-year period, what matters is where we are further out on the yield curve, where the drivers are a bit different. And if we look at current mortgage rates in the UK, say, you can see that they are starting to fall, albeit slowly. Currently, you can fix a 2-year or 5-year mortgage for around 5.4 or 5.8%. But I would expect to see that fall further as there's more competition between banks to offer those loans, but also because interest rates will be falling as inflation falls, particularly at the short end of the curve. Now, a lot of what I'll be saying for the rest of the video depends on understanding what happens to yields as the supply and demand for bonds changes. So we'll just cover that briefly right now. Now, bonds are no different from other things which you buy and sell. If you increase the demand for them, their price will rise. What's slightly different about bonds is that we also think about a thing called yield, which moves in the opposite direction to price. So higher demand means that prices rise, but it also means that yields fall. And of course, if we're thinking about interest rates, that's what we care about, it's the yield. So higher demand for bonds means that yields fall. At the same time, we also think about supply of bonds. If the government's borrowing more or companies are borrowing more, then there'll be an increased supply of those bonds. And assuming that demand for those bonds doesn't change, then we'd expect to see prices fall. And of course, because yields move in the opposite direction, yields would rise. So just bear those two things in mind as we go through this video. This video is sponsored by Trading212, a platform I've been using in the UK for some time now for my fund portfolio. Now, it's not just a low-cost platform, it's also very innovative. It was the first to offer a combination of commission-free trading combined with fractional shares. But they also have a new feature which you may not be aware of, which is that they offer interest on cash which is uninvested in multiple currencies. Now, you should check on their website for the latest rate, but currently, as I make this video, you can earn 5% on your uninvested sterling cash and 5.1% on your uninvested US dollars. Now, that interest comes with no balance limits, no withdrawal penalties, and that interest is paid to you daily. Furthermore, it covers 13 currencies. Another feature which I find really useful on the platform are called pies. These are like portfolios within your account. So for example, you could have a pie for a specific investment strategy. So for example, I've created a momentum value quality portfolio consisting of single stocks. And because prices are moving around all the time, I have to rebalance it. And I can do that with just one click on their platform. Furthermore, there's a social feature of pies where you can publish your pie to let other people see what you've done. Or you can use other people's pies to gain inspiration for your own investments. Now, as a viewer of PensionCraft, you get a special offer from Trading212 where you create a new account, you verify it, and you fund it with at least £1. Then you use our promo code, which is my name, R-A-M-I-N, Romin. And that way you can get a free stock worth up to £100. You'll also find a link to that in the description below. So just remember what we learnt before. If we have a higher demand for bonds, that pushes yields down. And if we have a higher supply of bonds, it pushes yields up. So remember that as we go through these different drivers. And we'll start with what's driving rates down. Now, further out on the yield curve, if you're borrowing for longer periods of time, or if you're fixing your mortgage for longer, then rates are going to be driven by things like growth. And this is nominal growth. It includes inflation. And the relationship is that if nominal growth is higher, that pushes yields higher. One way to think of that is if there's lots of economic growth, there'll be demand for things which get exposure to that higher growth, which is stocks. There'll be less demand for things which don't have exposure to the upside, bonds. So less demand for bonds is going to drive their price down and drive yields up. So that's why there's this link between nominal GDP and yields. Now, what we've seen over many years is growth is gradually slowing down in the US, but also in the UK. So for example, if we go all the way back to 1947 and we plot US GDP, this is real GDP, not nominal, and we create a kind of trend line, which I've shown in yellow, notice how recently GDP is kind of slumping away from that long-term trend. And this is a log plot of GDP, so a straight line would be a constant rate of growth. What that slowing trend means of real growth is that we're going to see probably lower long-term yields. So certainly that slowing trend of growth and productivity is pushing yields and interest rates down over the long term. If we look at growth in the UK, and here we've got data since 1955, it's a shorter period of time, but again what you see is this slowing down of growth, a slower rate of productivity growth. And again, this is going to push down UK yields. Now, for a long time, yields were low, and many economists were scratching their heads trying to explain why that was the case. Many economists thought that there was a high demand for safe assets, and there was a limited supply of bonds. So big demand for bonds means that there's going to be a higher price and a lower yield. So this was one of the explanations during that low interest rate period that we had before the pandemic. Another explanation was that there was a savings glut. Lots of countries had an excess in terms of exports. They were parking that in US treasuries and to a lesser extent UK treasuries. And because there was a higher demand for bonds, remember, that pushed down yields. Now, at the moment, I'd say those last two factors, there isn't a lot of demand for safety at the moment. People are piling into growth stocks again, and that tends to make bonds less attractive, and that pushes up yields. So until people are scared again, I think that demand for bonds is not really there at the moment. Also, the savings glut argument is not as strong as it once was, as many countries like China are exporting less. It's worrying for their economy, but it also means they've got less dollars to park in US treasuries. So net, they've been sellers of US treasuries over the last couple of years. Now let's turn to factors which are driving yields upwards. And the first one we'll think about is quantitative tightening. Now, in the global financial crisis, but also during the pandemic, the central banks were buying up their own government's debt. The reason why they did that was to push down yields at the long end of the curve. Remember, more demand for those bonds pushes the prices up and it pushes the yields down. However, since we've started to see this high inflation period, that quantitative easing has turned into quantitative tightening, and central banks are either selling those bonds which they own or just letting them mature. That's true of all of the big banks, such as the Federal Reserve, the Bank of Japan, or the European Central Bank. And of course, it's true of the Bank of England. Now, the Bank of England is fairly unusual in that it's actually decided to sell bonds. It says this isn't disrupting the UK bond market, but if you imagine we've gone from a situation in which we had a price-insensitive buyer, the Bank of England, buying millions of pounds worth of bonds, to one where it's selling millions of pounds worth of bonds, and to get a sense of the scale of those sales, it's going to sell 100 billion between September 2023 and September 2024. And at its peak, it owned about a third of UK government debt. So this is a very large holding, which is now being sold down. So thinking about what that does to yield, if it's selling, that means that the prices go down and the yields go up. So this is going to push up yields, at least at the margin. A shrinking labour force also pushes up yield. That's because a smaller labour force, assuming there's still a demand for workers, can negotiate higher wages. That's inflationary because it's passed on in terms of goods and services prices to end consumers. And higher inflation means that the central bank probably will keep rates higher than it would otherwise. Why would the labour market be shrinking? Well, one reason is demographics. As we look across developed markets, but also increasingly emerging markets, even in countries like China, what we're seeing is the dependency ratio, that's the number of people who are retired relative to the number of active workers. That dependency ratio is increasing rapidly. Japan's well ahead of the pack here with a dependency ratio of 51%, but you can see that other countries are catching up. Deglobalization is another trend which is making inflation higher and pushing up yields. And that's because deglobalization effectively means that you're going to have to bring labour into more expensive markets. Generally, domestic labour tends to be more expensive. That means production costs are higher. That pushes up costs for companies, which are passed on to consumers. So that means higher inflation and again, higher rates. Now, this process comes in various forms. One of them is simply reshoring, where you take your supply chains and you bring them into your domestic market. If your country can manufacture the things which feed your industries, then that would be the choice after the pandemic. That's when we had the huge supply shock and we discovered all of the interdependencies between different countries, particularly dependencies on countries which may not be friendly. And here I'm thinking in particular of the US and China. So the US has chosen to do a lot of reshoring as a result of that shock during the pandemic. Another variation is nearshoring. For example, US companies might choose to manufacture things in Mexico, and that's going to reduce transport costs because it borders with the US. And of course, Mexico is a friendly country for the US. Or more generally, you could do friendshoring, where the country might not be adjacent to your country, but at least it would be politically aligned or economically aligned with your country. But usually what we find is these different forms of reshoring eventually lead to higher prices, and that's going to be inflationary and push yields upwards. Increased government spending is another upward pressure on interest rates. Now, one of the causes of greater government spending are net zero targets. As we undergo this energy transition from fossil fuels to renewable energy, the government has to spend a lot in order to do that transition. So this will come in the form of infrastructure, say, for charging electric cars, but also revamping electric grids to handle supply from things like solar, but also wind energy. Now, there's a report by McKinsey which shows that this is not going to be cheap and it's going to be front-loaded. There'll be more spending in the few years ahead than there will be over the next 20, 30 years, say. And the cost is going to be a fairly staggering $275 trillion. And that's about 7.5% of global GDP over the next 30 years. Now, increased government spending means a greater supply of bonds. And if you increase the supply, that pushes down the price and it pushes up the yields. So this is going to be pushing up interest rates as there's more supply of bonds. Now, we saw that there's a greater dependency ratio in many developed and emerging countries. That usually means you're going to have to spend more on healthcare because as we get older, we rely more on healthcare services. So if we look at a graph of life expectancy versus the health spend per person, you can see that there is a general upward trend. Older societies cost more in terms of spending per person on healthcare. So an aging population means probably higher spending by governments and higher yields. What we're also seeing is greater military spending across the world. So if we look at how much each country is spending over time, that's increasing significantly at the moment because we have some major conflicts going on, which are very expensive. Many countries are helping Ukraine, for example, militarily, and of course that can be expensive. So whether it's indirect or direct, many countries are spending more on defense. And of course, that's going to increase issuance of bonds and again, push up yields. So in summary then, I think what we're seeing at the moment are the after effects of that supply shock and also the inflation shock that we got after the pandemic. Now the quick wins of that are already starting to subside. Energy prices are falling sharply and turning into deflationary forces. And that in turn is going to push down yields. And those quick wins will probably last over a period of 2 to 3 years to come. So that big spike will subside to a certain extent over the next 2 or 3 years. So if you're thinking, when should I remortgage? I think probably it's worth waiting a couple of years to do it if you can. If we think about the level of interest rates we're going to reach after that 2 or 3 year period, it's going to be significantly higher than it was pre-pandemic. And what's very notable is that US rates will be significantly lower than the UK rates. And that's because inflation in the UK is taking longer to subside. So for example, by the end of 2026, if you believe the forecast from the central banks and the OBR, then the UK's rate will be about 1 percentage point higher than the US. Then once we look at the structural factors, those long-term drivers, which extend far beyond that 2 year period ahead, it's pretty clear that there are lots of factors pushing rates up and fewer factors pushing rates down. So personally, I wouldn't be surprised if rates stay higher for longer, much longer than people expect. Now that's not all bad. Lots of people are savers, for example, and for them, higher interest rates are good news. Now don't forget our offer from Trading 212. If you open a new account with them, verify it, fund it with at least £1 and use our promo code, which is my name, Ramin, R-A-M-I-N, then you get a free share worth up to £100. And as always, thank you for listening.